I want to click the marker. Let me start over again. There we go. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Huh? Just by coincidence, you see? Yeah. Ooh, there it is. University of Oxford. Isn't that funny? In the thumbnail, I was wearing the shirt. I didn't plan it that way, man. Didn't plan it that way. But anyways, good morning. How are you? Oh, that's so good. That's so good. So what do you want to do today? Why don't we go through the financial markets? We could do gold, oil, and Bitcoin and other cryptos if you want, especially if you're worried about the Binance situation. Sure, fine, great. We can do that. I wanted to, I don't have direct access to it, but I'd like to pull up a 2-year note. You want to look at that? The 2-year note? Sure. But let me know what you want to do, and I'm happy to try to cover that. In the description below the video, there are links to fabulous resources. A link to my book, a link to Quant-in-a-Box, a link to FX Bootcamp, a link to Trader's Way. It's all big stuff. The book, well, it covers technical and fundamental analysis, both those strategies. But then the last third of the book is on how to journal properly. So 1/3 of the book, fundamental analysis, 1/3 of the book, technical analysis, 1/3 of the book, how to journal properly. Yeah, and it's that big of a deal if you're a new trader. Faux show. FX Bootcamp, 88 hours of foreign exchange trading, college level or college style, university style lectures. Okay. There's also live groups. Today is a very busy day at FX Bootcamp. We have the Stop, Look, and Correct session, and we also have the day trading group. So at 2 and at 4. Roderick says, hey man, the outlook was awesome. Very helpful. Thank you for your time. Namaste, sir. And you're like, that doesn't actually make sense. Namaste. Because it doesn't mean thank you, does it? Oh, whatever. You're welcome. Cool. So, FX Bootcamp, join. Quant-in-a-Box is your macroeconomic Quant-in-a-Box. And then Trader's Way is a trustworthy, ethical foreign exchange broker. The one foreign exchange broker I recommend. It also has metals. It has some stock indices. It has some crypto. It's wonderful. 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 So check them out, tradersway.com. There are many like it, but this one is mine. Cool. So good to see you. It's been a long week. What day is it? Tuesday? So anyways, just kind of checking out. There are some people worried about things going on. Are you worried about Binance? Are you worried about Charles Schwab? See, one of the issues is when interest rates were near zero, banks were kind of forced to gobble up bonds that paid near zero. And now money markets pay like 4%. So people are like, I don't want to keep my money in a bank. I want to put it in the money market. So you put it in the money market by withdrawing from the bank, and now the bank is forced to sell its zero, or ZERP, near zero interest rate bonds. They have to dump them at a loss, and now we got a problem. And it may not actually be a run on a bank. It's just people moving money to a money market. Did you know there's $5 trillion in the money markets right now? I think that's interesting because the federal government pumped $5 trillion into the market, as well as the Fed, but the Fed could withdraw it. So where's that excess money that the federal government pumped into the market? See, if the federal government pumped $5 trillion into the entire market through just giving people money, literally money just entering your bank account, most people spend it, right? Those that don't have a lot of money, they have to spend it. They're like, oh my God, I got money. I can pay my rent. I can go, I can buy a TV. I can fix my car, but whatever they consume. By lack of a better word, poor people consume and rich people invest. But what happens is if you, as you consume, you spend this free money on products and services. Who owns the companies that own the products and services? Well, wealthy people, right? Because they don't spend the stimulus checks that they got. They just got it, and they didn't really need the money. So what do you do with it? I don't know. Okay? So, but eventually what happens is it all trickles down so that wealthy people have all the money. Hey, the poor people that got free money could have invested it, but they spent it. Whatever. Again, don't get all upset about poor versus rich. There just is a difference. There's consumption and investment. Some people will take stimulus check money and use it to consume. That's what it was actually designed for. But people that didn't consume it, they don't really need it, so they just don't spend it, which is a form of savings, because savings is equal to investment. But what I'm saying is, if you own all the if you invest in the stock market, for example, then you own the companies that benefit from the consumption. So eventually now you have all this, the rich people end up getting the full $5 trillion. And that's the interesting thing. On top of retirement accounts, on top of mutual funds, on top of, passive investing and all that kind of stuff. On top of all of that, there is now $5 trillion in the money market. And the funny thing is, that's exactly how much was pumped into the economy due to COVID from the White House alone. And I'm wondering, and that's dramatic, by the way. The amount is dramatic. So you're like, how much of that is just the stimulus money now being parked there? Because eventually all that stimulus money will drop into the 1%, right? Kind of interesting. And it's interesting that the unintended consequences. Now, you guys might remember this when the very, very beginning of COVID, I said, when there is government intervention, there's always unintended consequences. Always. And I'm like, but you never quite know what the unintended consequences are if you happen to do something unique for the first time. So if the government comes in and says, people can't afford rent, so we're going to dictate a maximum rent. Well, we know the unintended consequence. Now, the idea behind saying people can't afford rent, so we're going to put a maximum ceiling on rent to keep it affordable so everybody can afford a home. Okay, they're trying to do something good. But we know the unintended consequence is in 10 or 20 years, there'll be a radical shortage of houses and nobody will have a place to live. That's the unintended consequence. So I said, so what's the end? We don't know what the unintended consequence of the government just giving away $5 trillion for free. Now, one of them is likely inflation, and we got the inflation. Okay. Now, remember at the very, very, very beginning of COVID, I said something radical like inflation would go to 5%. Does anybody remember that? I said unemployment could go to 5% and inflation could go to 5%. And It was absurd. You're like, Wayne, we haven't had 5% inflation for 50 years. Well, I didn't say 10, I said 5, and we got 10. Nobody remembers that? It might have been an Off the Charts with Wayne McDonald. Yeah, I remember talking about that. I said there's going to be a new level of full employment. Full employment is going to be 4.5, and normal employment would be closer to 5. Nobody remembers any of that? Wow. As long as I remember that, it's good for me. So the unintended consequence here, it's kind of interesting. We went through a period of banks loading the boat on bonds that paid almost nothing. And now the unintended consequence of giving money away for free and a slow Fed, so it's partly the Fed's fault and partly the government's fault. The Fed was way too slow and inflation went way too high. So the inflation came from the White House, not the Fed. But the Fed was slow to act. So what they had to do is then raise interest rates ridiculously quickly. Okay? And what's the unintended consequence of all this? All these mistakes. Well, now people are like, holy crap, why would I keep my money in a bank when it only is going to pay me 1% interest? Now, why is it only paying 1% interest? Well, when interest rates were 0 for so long, that's the Fed's fault. The only bonds a bank could buy were 10-year T-notes that paid 1.5. Remember? At 2 years, only paid like 0.75. So the banks were forced, it was the only thing to buy, and banks buy bonds. So all of a sudden they build this huge portfolio, billions and billions and billions and billions and billions and billions. It's not very profitable, but it's the only thing they can do to earn money. So that's what they did. That's what banks do. You can't get angry at a cuttlefish for changing its color and texture. That's what the cuttlefish do. Well, bankers buy bonds with deposits, right? So now they have all these billions of dollars in deposits converted into billions of dollars in bonds, and these bonds, because they can't buy stock, they can't buy real estate. It's against the law. Banks can only buy treasuries. So they buy a bunch of treasuries that pay hardly anything, which means deposits, because the bank can only pay interest based on what they're earning over here. So they're earning 1.5 here, but paying 1 there, keeping the half for themselves. That's what a bank does. So suddenly now these banks still pay very, very small interest rates because they have billions of dollars of bonds for the next 5 to 10 years that pay almost nothing. So what's the unintended consequence of that? Remember, it's not the bank's fault. It was the only thing you could buy. So now that things have changed so radically and so quickly, investors are like, or depositors now are like, you know what, these money markets are so liquid, I can just do what the bank was doing with my money, taking my deposit and sticking it in the money market. Well, why don't I just stick it in the money market now and I'll earn 4%? Why would I leave it in the bank and only earn 1%? Uh-oh. So maybe it's not even a run on the bank. People can do this now on their phone. Remember when it was too difficult? People didn't know this kind of stuff. So you just relied on your bank and you had no idea what was going on with your money. Now you're just like, everybody's sophisticated, right? They're like, oh, I'll just move that on my phone. Boom. I just moved my money out of the bank and into a money market account. Uh-oh. Uh-oh. And it just happens to be $5 trillion, the exact number that was pumped in by the Fed and the White House. So I think it's all kind of interesting. It's all kind of interesting. Sorry for going on that tangent. You're like, dude, what? But it's what's on the market's mind. Okay. But how come these guys make stupid mistakes? Meanwhile, they have people with PhDs in economics. Well, is it a mistake, or is it? I would argue that they knew what they were doing based on the information they had at the time. And so think of it from the Fed's point of view. The Fed says, well, if we raise interest rates too quickly, and I'm not talking COVID now, I'm talking 2008, 2009, 2010, 2011, 2012, all the way up to COVID and then post-COVID, right? The whole period. If they raise too quickly, they kill the market. So they're like, if they keep interest rates low for a long time, what's the likely consequence? The economy rises. Okay? So if the Fed keeps interest rates low for too long, the consequence is the economy is going to boom. If they jack up interest rates too early, the economy falls. Do you see, like, Frank, which one is the better mistake? Now, you also have to think about it from, what a PhD in economics would worry about is inflation is tolerable. Inflation, right? Inflation is tolerable, Frank, because what that means is everybody has money. I'm not talking about third world inflation. I'm talking about first world inflation. There's a little bit of a difference. In this case, the economy is expanding, it's growing, and that's why there's inflation. Many third world countries have inflation, but they don't have any growth. So in this case, we have a mature economy, and there's some inflation. Okay, not 30% a year kind of stuff. Okay, so let's get back to this. There's inflation, which means the economy is working, people have jobs, we have full employment, we have growth, we have productivity. But we also have inflation because there's too much money going around because money is still too cheap. And that money gets put into the market, which means everybody has a job, which means they're spending, which means all the companies are making money, which means you get a raise because you could easily switch companies. And all of a sudden, yeah, it's not healthy, but the consequences, at least on the short run, it seems like everybody's rich because you make 5% more than you did last year. Well, if you continue that for 20 years, then you find out your money is worthless and it's not quite true. So, but on the short run, it feels like you're rich. Because again, everybody's working, everybody's being productive. And then what could the Fed do to then combat that? Raise interest rates and slow it down. Now, what if you have falling inflation? Okay, prices are falling because nobody can afford to buy a house. Nobody can afford to live in an apartment. Nobody can afford to buy $1,000 iPhone. Nobody can afford to buy $300 pair of jeans. So now everybody's shopping at Walmart, right? Nobody's buying a new car. So you can start to see, like, mechanics will do well, but car dealerships won't do well. Walmart will do well, but I don't know, Macy's won't do well. And you start to see that prices start to fall, and they continue to fall. And because much of the market isn't doing well, you're not buying a new iPhone, so Apple shares are falling. So those with wealth now are losing their paper value, which makes them tighten their purse strings. And then companies start getting concerned about falling revenues, falling profits. And so they start to cut jobs, which then, okay, if you know Sir, what's his name, Lewis, what's his name? Lewis, Sir, the economist from St. Lucia who won the Nobel Prize. You know who I'm talking about? Lewis, Sir Arthur. I think Arthur, right? Arthur Lewis. He talked about a vicious cycle of down, 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 down. You lose your job, so you cut spending. So someone loses their job and they cut spending. And what happens, Frank, is the vicious cycle of falling inflation is almost impossible to stop. So look up Sir Arthur Lewis. Okay. He studied, I think, he did some work at, was it Yale? It might have been Princeton. I'm going to guess Princeton. His undergrad was a London School of Economics. He was born in St. Lucia. His work actually had to do, it was actually pretty interesting, the development of third world countries, the economic development of third world countries, and he studied in particular the Caribbean because, and get this, everybody knew at the time that white Northern European people were genetically superior to all other races and cultures in the world. It was a scientific fact. According to the Germans, the French, and the British, white people were superior in the early part of the 1900s, right? Well, according to them, they were superior. Why? Well, they were richer. And so anyway, Sir Arthur Lewis, who's from the Caribbean, getting an education in the London School of Economics, well, he's black. And they're like, well, clearly white people are superior. Look how rich all the white countries are. And he's like, is that actually true? Like, so he studied it. And of course, he said, well, there are a lot more other factors going on than your genetic whiteness. It had a lot to do with, inherited, your dad's education, but it had a lot to do with like environmental stuff. Literally the productivity of farms in, Germany were significantly superior to the productivity of a farm on St. Lucia. You're like, the only thing that grows in St. Lucia is sugarcane, so you can grow a lot of other things, a lot of different stuff in Germany. And so you're like, well, that's kind of an advantage. And you inherited that land, right? So anyway, so he went through, and it actually had to do with a lot with, when you start with nothing but labor. Imagine the poorest countries in the world. No factories, right? No railroads, or very few. No roads, or very few. So what infrastructure do you have? You have no capital, but you have almost unlimited amounts of labor because nobody ain't doing nothing. Okay? And then how do you transition to like a modern economy where, you're more capital intensive than you are labor intensive. And so he studied that, and he's like, guess what? Europeans are not necessarily, this was controversial at the time. Your genetic whiteness really wasn't, the deciding factor on how superior your economy is. It might have to do with other things. And part of his study, he was talking about how third world countries get into this problem where you don't have infrastructure, you don't have education, you don't have institutions, and you never get out. It gets worse and worse and worse and worse and worse. And now if you apply the same idea to, why did the Fed move so slow? Don't they understand that they created all this inflation? Well, again, put that into context. if we were in disinflation and inflation was falling and falling and falling, you would lose your job, so you would stop spending money and you'd lose your house because you can't afford your mortgage. Now, all property values are falling because your neighbor lost his house, because he lost his job. And then your auntie and your uncle and your brother and your sister and your cousin and your friend, they're all losing their jobs. They're all defaulting on their mortgages. The stock market's falling. The housing market's falling. Nobody has money to buy anything. So more layoffs are coming. And all of a sudden, this is a real problem. And now, how do you get people to stop being poor? Like, you lost your job and you lost your house and you lost your retirement account, but cheer up, get back into the market. How do you do that, right, Frank? And all of a sudden, your disinflation leads to recession, and then recession leads to depression. You see? And all of a sudden, you're screwed. There's nothing the Fed can do to get you to start buying stuff when you ain't got no money. You've lost it all. You've lost all your wealth, all the equity in your house gone, all the equity in your retirement account gone, all the money in your bank gone. Okay? So now what could the Fed do to make you feel rich again? Nothing. It's impossible. Okay, Frank? So then you take the better choice. You're like, if we're going to make a mistake, we're going to leave interest rates low for too long, let the economy heat up, and inflation will grow, and then we will temper that. We'll temper that. So once the economy is booming, okay, you'll raise interest rates and cool it off, a little at a time. We might have 3 or 4 years of high inflation, higher than we would like inflation, but you could slowly temper that down, and maybe over 10 to 20 years, you're back to sort of more normal levels. You can manage it versus, right, a vicious cycle that you can't get out. Okay, does that answer your question, Frank? It's sort of a Sophie's choice. You have to choose one. Choose your mistake, and that mistake is easily fixable. Okay. Yeah. What I think is worse is politicians come in and they don't know what the hell they're doing. They're just reacting, and they make very poor choices very often because they're thinking of politics, but they're not thinking of economics. So they just don't understand the consequences. So like in your first finance class in university. So you go to university, and this is your first year class in economics, and there's a demand, a supply, okay? And then you have equilibrium price and equilibrium quantity. Oops, I got that one a little off, but let's do it here. Okay, and then the government comes in and says they don't like that because they think this price is too high. So the government comes in and says, we know better. We know what our citizens need. So prices are too high. So you can't charge more than this price. Because we want prices to be low. And that's what a politician will say. The people are suffering from high prices, so the government will come in and mandate you cannot charge more than that. Okay? Okay, and that's a problem. Because suppliers will give you this amount of quantity, And the market will demand this amount of quantity. And there'll be a shortage. Right? And that's the unintended consequence. So a government official will come in and say that prices are too high. Yeah, Jim says Elizabeth Warren going after Powell to get him fired. Well, yeah, but that, I mean, again, she's playing politics. Look, for the constituency that she represents in the United States population, she's doing a great job. Now, you might disagree with her, others might disagree with her, but she represents citizens that share her point of view. And with that point of view, she's doing a good job. Now, I think about Powell, and I suppose it's not good practice, but I wish he would say the Fed pumped in $5 trillion, the Fed is taking out $5 trillion, and inflation is down. But the government put in $5 trillion. They have not taken out $5 trillion, and in other parts of the economy, inflation is persistent. So what will you do, Miss Warren? As a senator of the United States of America, you pumped $5 trillion into the economy. The Fed pumped in $5 trillion. We're in the process of removing the $5 trillion. When are you taking out your $5 trillion? You see what I mean? Like, when are you going to act? Because right now, the federal government hasn't done anything. And yes, we still have inflation. Okay? Okay. Family Ties says, nice presentation yesterday. Thank you. However, which condition Dixie go down and the stock market go down, or both? Well, typically, I mean, that's straightforward, Family Time, right? If the stock market goes up, the dollar weakens. If the stock market goes down, the dollar is strengthened. So that's, I assume, right? I assume that in the knowledge, but maybe to my mistake. Okay. And so you're under which conditions? So in that presentation, I outline the two mathematical formulas that produce a recession in a scenario of interest rates going up. So by mathematics, I explained that under which condition. So that was the whole point of the presentation. Just so you know, inside of Quant-in-a-Box, the presentation is here. Oh, well, there you go. Okay. So if this, let's do it this way. Okay. If this stops going up, okay, this stops falling. And then in the future, maybe next year or the year after, it might even be a lot longer than that, but this is what the market is trying to figure out. But if, let's say next year this falls, then this goes up. But this is only part one, remember? So that is almost, that's already been played. You know what I mean, family time? This is probably already played out, and we're much more interested in the second part, the second equation. And part of the recession had to... Okay, so we're more interested in this right now. Cool. So anyways, it's pretty, right? It's pretty. Okay, so anyways, let's get going. Has crypto collapsed? No. There's jitters on Binance. I just want to show you, like, this is daily, and this has been the plan for a week and a half. Okay, you're like, well, it hasn't gone up. Well, but it hasn't gone down either. So is there any freak out going on here? Not really. I mean, it comes down to your opinion. Is that freak out mode? No, it's actually sort of predictable mode. We're caught up on the the central pivot. Like, it doesn't look like freak out, right? Doesn't look like a freak out at all. Okay. We're in a major sell zone. This is a major sell zone, huh? Major sell zone. But bulls bought at the exact right price. And now this is where bears should sit up and take notice. So if it collapses here, you can say, oh my God, it's Binance. I'm like, well, actually, we knew 100 days ago that was a price to start selling. So, to each his own. Okay, XRP ain't going down. Okay, so anyways, I don't see panic yet, if any, in that market. Looking at the same thing from a different point of view. Okay. See, so I look at it. This 4-hour chart says, don't be shocked if we double top and drop. Okay. Up to 28,000, down, like way down, back down to 18. That would be indicative of a stock market decline, significant stock market decline. Okay. Up into the gold country. Okay. There's our little bouncy bounce. A little bouncy bounce. I had it coming down closer to, what did I say yesterday? Was it buy at 1950 and then the next one was 1930, 1925? I think that was our buy zone. I know there's another one way down here, 1900. I think we had to go to the daily. It's so funny, like, we do this all the time, huh? Yeah. But I am a bull on gold right now. I am. And of course, you might say, well, Wayne, down here you were a bear. And I'll say, uh-huh. Yeah. Things changed. Now, this, I think, I disagreed sort of with the market, if you will. I think there was way too much front running here. Way too much front running here. But I understand, I think this is more appropriate. So even though this was a big move, I believe most of that was guesswork. Yeah, 1950, 1925. And then I think the next one was 19. But anyways, going back to this, I disagreed with that move, but I understand this move, the narrative here. And so, yeah, the narrative is significantly different than here. Now, this is guesswork. Now, they may have guessed right. I understand the guessing they did, actually. I actually understand it. In fact, I think I predicted it. Maybe not gold, but the stock market. And to me, it's the same thing, but whatever. But the story here, I can support with evidence. Okay. Cool. Hey, by the way, I think maybe next year I'm going to start that fund I was telling you about, the income fund. And I think the way I'm going to do it is truly sell it, start it as a proper style fund. I'm going to create a company. And I'm going to sell shares in the company. Okay? And a fixed number. Okay, let's say 1 million shares. And you'll buy in, and you'll get paid based on how many shares you own. And the interesting thing about this is down the road, you could potentially sell your shares to somebody else. Because there's a limited amount. And of course, you have the net asset value of the investments the corporation's going to make. So that when you buy shares, the money goes to the corporation. So it's like an IPO. The money goes to the corporation, and then it invests into its strategies, most of which, 80% of it, will be backed by assets. So these assets will, These assets will be worth something. Okay? So 80% of it will go to buying assets. So it's an asset-backed corporation. But then 20% of it will go to strategies to earn income. Okay? So Forex. Okay, dividend, options, and contracts. Structured deals. So doing deals directly with banks. I found out if you have enough money, a bank often gets unbalanced as far as its risk portfolio because of their customers. They're very sensitive. For example, they may have financed a ship bringing iron ore from Australia to China or to somewhere else, okay? And they finance that, which is totally normal. This is what banks do. And there's a contract. The ship picks up the iron ore and needs to deliver it to port, okay? And it needs to arrive in a certain amount of time. And so there's all kinds of finance that gets involved, like, standby letters of credit and, all these different things to finance that it's going to show up. And along the way, the ship breaks down. It's halfway to China and the diesel engines fail. And it's going to sit at sea for a week before it can get fixed. And so all of a sudden, there's a problem. Because there's currency risk involved, there's contractual risk, there, money's at risk here. And so if you're a big enough fund, the bank needs your help. They're like, can you take the other side of this risk because you're better at hedging it than we are? And for doing that service for us to get our risk profile back to neutral, we'll guarantee you a 2% profit. Now, you got to go out and hedge your risk, right? Your risk is like the currencies move more than that. And well, you go do what you do. But we'll sign a contract with you. And I'm like, dude, you imagine you could put 10 million to play on something like that? And they're like, well, we'll guarantee you 2 million by the end of the month, as long as we can get our books neutral. And you take care of the risk. Now, you got to deal with the risk, but nonetheless, right? And you can hedge it all out. So it's just a service. So anyways, so my thought here is 80% goes to assets, 20% go to strategies, right? So you got a carry trade here. Dividends are basically a carry trade. Here is how you're hedging your assets. And then this is another way to earn income. And the whole thing is designed so that your net asset value just flows with the market. So you own a bunch of assets that just represent the beta. So if the stock market falls, it's not because your net asset value doesn't fall because you picked the wrong company. What if you owned 400 companies? 300 companies. It's like owning the S&P 500. You're like, well, you're diversified. So if the stock market goes down, the stock market goes down, but you're still earning money. If the stock market goes up, well, great. The stock market goes up, but you are still earning money. So the point isn't this. These are just assets. So I would think like this would compete with owning real estate. Huh? And I'm like, because how does real estate work? You own the building, which is the asset, but the value of the asset goes up and down. Usually up, but it can fall. So you own the building, and over here is the income you collect. Now rents go up, rents go down, vacancies go up, vacancies go down. There's different strategies. Maybe you need to borrow against your asset and improve the property so you can raise the rents by making the building more attractive. That kind of stuff. But there's asset and then there's income. And the thing is, I would want to design it so that the asset, the corporation, pays everybody, its shareholders, 1% a month. I'm wondering if I can do that. And that's gross, not net, but just to make it easy. Can I use the 20% to produce 1% a month to give to the shareholders? And you're like, is that a lot? Well, it's what? Not quite 15% a year. Meanwhile, this just fluctuates. Okay. And one of my thoughts is if you're under retirement age, if you're not retired, I might force you to reinvest the 1%. Okay? So that every 5 or 6 years, okay, the net asset value doubles, which means your account doubles. And it compounds and compounds and compounds and compounds and compounds. But if you're retired and you have $1 million in the account, you earn $10,000 a month and you live on that. And meanwhile, it's run, the portfolio's run like it's an endowment. So that when you die at a ripe old age, you've been living on $10,000 a month per $1 million invested. And when you die years later, that $1 million is still there. And you give it to your kids. But meanwhile, you've lived on it for years and years and years. $10,000 a month. Okay? Well, the issue, Cash, is taxes. That's why, right, there's two things when I've analyzed this. You really want to invest your SEP, your IRA. I don't know if you can self-direct a 401k. But because the way I would design the company, the fund, is it would earn income. Now, income is taxed very high. Anytime you earn income, you're kind of taxed like you're poor. It's not a distribution. It's not like you're an owner. It's like being an employee. Not the owner of the company. It's like being an employee. So you have to pay a lot of taxes. And you're like, well, by the time you pay your taxes, it eats so much of your profits. Okay? And even if you don't pay yourself, so you're like, oh, well, I'll just take the income and I'll roll it back and I'll buy more stock with it, right? Yeah, but it's still income. You've decided to reinvest it, but that's your choice, but it's still income. You have to pay taxes now, even if you didn't pay yourself. So you're like, what? I didn't pay myself and I have to pay taxes? Yeah. So at the very least, you have to take enough out to pay your taxes. Oh, well, that sucks. I know. Sucks. But if it's your retirement account, this is all tax deferred, which means you don't pay taxes now. You pay taxes after you retire. So, right? So let's say when you're retired and the fund is paying you $10K a month per million. Okay, you're going to pay taxes like you have a $10,000 job. But here's the thing. If you had, let's say you did this when you were 55, oh, not 55K, 55 years old, and you put in 100,000 and we're hitting our goal of about, on average, roughly 1%, right? That's the design. We don't know what the actual outcome would be. But you invest in 100K when you're 55, and when you're 60, it's 200K. Okay? And then when you're 65 and you're ready to go from compounding mode into an income mode, you now have $400,000 in the account. Okay? Which would pay you $1,000 a week. Okay? $1,000 a week forever, because again, I'm trying to create an endowment. Remember, I took a class at Harvard on managing endowments. And the point of endowments is that the principal lasts forever and ever and ever and ever. Think about your money being managed like you're Rockefeller, so that 200 years from now, maybe your money is still around. Well, of course, we know you're going to leave after you die, you're going to leave your money to your children or your grandchildren, and they're going to burn through it, right? Like, oh, grandma's money. Cocaine, prostitutes. Done. Thank you, grandma. Okay, so whatever. I can't do anything about that. But it would be great if I can find a way that you can earn 1% a month and maintain the principal. You never sell the assets. That 80% I told you about, those assets are designed to be in the fund in perpetuity, like an endowment. So you can manage money for libraries and museums, the symphony, a university, in this case, you. Anyways, so I've been talking to people about the legality of that. All income, just all income. And the rest is just assets, just sitting on assets. What would be the minimum amount? Well, I'm trying to work that out because it's an amazing amount of work. The compliance, the accounting is nightmarish. It's a nightmare. So, it's a hard, my first thought is 10,000 wouldn't be enough, but maybe you could do it. 25,000 would be better. But here's the thing. I mean, if it's a retirement account, if you're in your 50s, it should be, you should have $1 million. So why would you piss around with a $25,000 investment? But, I don't know. So, I don't know. So the thing is, how much money do I need for the fund to work out mathematically? So let's say the fund needs a minimum of $5 million. So you could create 5 million shares worth $1 each. But then what if somebody invests $1? Now you got to calculate how much income they've earned and how much needs to be rolled over. And you're like, dude, it'll cost me $1,000 a year to handle the $1 account. So all of a sudden you got to go, whoa, whoa, whoa. So is it 10? Is it 25? Okay. Cash says, do you need to be the accredited investor? And I want to design it so you don't have to be accredited. That's a key point to this. But then again, you can't be poor and save for, $50 for a retirement account. It's too expensive. So, it's hard to answer that. I don't know yet. Okay. Yeah, but for 100K, yeah. But how many people with $100,000 investments are in hedge fund type strategies? None. Because there's not enough in it. That's the whole point. So I almost look at it like a charity. Now, Peanut Butter Hero says for the 29-year-olds who want a 50K. Well, the interesting thing is if you were 30 and you put in $50,000, and let's say the fund on average achieved what it's designed to do. Let's say it did 10% a year. Holy shit. That means you're doubling your account about every 5 years. Oh God. And that's the part that I really like. It's that's really cool. So it's, how do you take someone that aggressively wants to save for retirement? You want to reward them like crazy. And then there's the other constituency what if you've saved your whole entire life and now you're approaching retirement age, or you are in retirement age, and you need the income? Oh my God, I'd want to do that for you. And I know your wealth manager ain't doing jack. And I know your wealth manager ain't doing jack. And they're certainly not hedged. And that's the thing, like the fund to achieve perpetuity would have to be hedged all the time. And somehow I'm like, oh God, that's what most people need, especially for retirement accounts. So you basically think of the other 20% as the hedge. Now you can leverage that, right? So you are always at least partially hedged by design all the time. So when the market's falling like it has been, the net asset value will fall because the market's falling. I can't do anything about the market, but I can still earn income. So you're like, wow, my net asset value is down for 2 or 3 years, but then my net asset value might be up for the next 2 or 3 years. And then after that, it'll continue. The NAV continues to keep going up. And then in the next recession, then the NAV goes down. But you remember that you just own assets. It's just like owning an apartment building. You're like, okay, the apartment building value goes up, the apartment building value goes down, but it's not mark to market. You just own an apartment building. You look at it, it's the same apartment building today, tomorrow, the next day. The apartment building never changes, only the paper value, right? So you're looking at it, you're like, that apartment building's worth 10% less than it was 5 years ago. Well, it looks the same to me. Right? Nothing is actually in reality changed. It's the paper value. If you don't sell it, you're fine. So if you own those assets, you own those assets. These would be blue chip type companies, right? So you're like, okay, well, we all know these things, and in the long run, they should grow. But that's not what the focus of the fund is. That's just assets. It's like buying a bunch of gold or something. It's what's parked in the vault. The thing is, gold costs you money. I want to buy a lot of things that produce income because I want to give you money. That's my whole thought process. Now, it's not the only thing, but what if out of, let's say, the 300 or 400 different stocks I buy, so we're diversified, because remember, I'm trying to hedge, but the vast majority of them are paying 2, 3, 4, 5, and 6% dividends. Well, cool. Then let's say if I'm averaging 4% annually in dividends on that portfolio, cool. Then I'm at least 30% to accomplish my goal just on the assets, right? Just on the asset. So that's cool. So now I'm 1/3 there. So now I got to find, how can I take the rest of the 20% and earn 6% annually? And you're like, dude, I think you could do that. And I think I could do that too. You see what I mean? And if the fund overproduces, I don't want to give you more than the 1%. I want to reinvest all of that because I want the asset portfolio to grow. Okay? You see where I'm going? Like, I think I could do that. we looked at it briefly, just sort of like for systemic risk. But I think a lot of the trades are just in between. Once again, we're just waiting for the new quarter. Okay? So the issue, Denise, is I have to make it design it so that it's for non-accredited investors. I think I can do it. See, I think eventually what I'll do is I'll design the first one to be unaccredited, and it'll have to be structured and managed and all the legal documents, all the compliance, all has to be around non-accredited. So the fees have to be higher because it's just, well, it's what's required. I have more responsibility to make sure that it's done fairly, legally, and correctly, and all that kind of stuff. So the costs are higher, so I'd have to charge a higher fee. And then I think after, let's say, 2 or 3 years of success there, I would then do a second one for accredited investors. So that's people that earn more than $200,000 a year. Okay? Or a family that earns more than $400,000, right? Combined two incomes, right? Which is not that, we're only talking about the top 5%. Okay? So if but that could be structured differently. Now, it would be regulated in a much different way and all that kind of stuff. But I could probably lower the fees, and it would be designed for someone to put in, let's say instead of a minimum of 25, it's a minimum of 250,000, right? But then the fees are lower, but it ends up being the same exact fund. But it'd have to be a separate corporation, and you'd buy shares and all that kind of stuff. Oh, and I forgot to finalize my thought there. So one day, let's say you decide you want to sell your shares in the company, you're a shareholder. Remember, I'm literally like an IPO. I would do an IPO, and you put in X amount of money, which is X amount of shares, and now you own that many. And the net asset value and the income, it's all being produced. And at some point, there's no more shares to sell. You can only sell 100% of the shares. So wouldn't it be cool, to design it this way? Let's say in 25 years, the fund is just crazy. It's doing exactly like it was designed to do. There might be a secondary market where you could sell your shares. Not just withdraw your money from the fund, but the fund itself could go up in value above. There could be a premium above the net asset value. So wouldn't that be cool? Like Berkshire Hathaway. One day, right? You could sell your share, which means you're exiting their portfolio of companies, but you can sell your share now to somebody else for $20,000. So imagine it's designed just like Berkshire Hathaway. Okay? That you could just, instead of cashing out of the fund, which is kind of expensive actually, you can just sell your share to somebody else and they take over your position. And if you owned 100 shares, you can sell pieces of it to people, because instead of, being kind of locked into, you could just sell this guy will buy 3, this guy will buy 33, this guy will buy 12. And there's just this liquid market. And you can just sell your shares and it's easy, right? So anyways. Anywho, sorry, lots of daydreaming, I know. I hope you don't mind the tangents, but I always like talking money. And so to me, it's just money. Okay, so look, this is what this chart is telling us. Anything lower than that is bearish. Anything higher than that is bullish. Okay, you might count this as your pivot. Okay, and so you can just eyeball it and know it's there. So that's what I just drew on the daily. Okay, and now we're sort of caught in this area. Whoa. So anyways, but that's the problem. I think I ran some basic numbers, and for it to sort of break even as a business, remember it has to be a business too, right? There's going to be accountants and lawyers and customer service people and compliance people. Like it's gotta earn money to support itself. Like, you know, it needs a minimum of 5 million. Minimum. Otherwise, it truly turns into a charity. Okay. Yeah, peso, the normal remittance would be coming up. You can look at it here. Okay, so this has been playing well for, quite a bit. You know, here's the lower low, lower high. Okay, oops. Pretty standard here, right? Top, 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 lower low, lower high, lower low, lower high, lower low. Yeah. Thomas says, which one is better, buying shares or trading Forex? Well, look, what I'm talking about, like the fund is passive. The fund itself isn't passive, but for you, it's passive. Okay. If 80% of it is asset backed, then the other 20% is active to hedge and earn income, right? Because that's what income is. You're earning money. Well, if the net asset value is falling, but you're earning money, then nothing, you've lost less money, which means you're hedged. But the thing is, based on taxes, it's for retirement. So I'm thinking if you're a Forex trader, okay, if you're a Forex trader and so you're doing Forex, that's your business. You're managing your AUM, or maybe you're trading for other people, and so you have their assets, their cash, okay, and you make, let's say, $300,000 a year. That's how much you make. That's how much you get paid. Or maybe whether you're trading other people's money or it's just your money or whatever. Okay. You can put aside about, I think these numbers are about right. I'd have to triple check. But anyways, you could put 50,000 aside, tax deferred, because you have a separate, I never remember what this is, SEP. It's like a 401k for a small business. Okay? So you don't have to pay taxes on it now. You're taxed like you only made $250,000. The other $50,000 you can give to me. Well, your SEP. I can never remember what the hell that something. I don't know. Anyways, it's your 401k. And it goes to the here, which I manage. Okay? And then when you are retired, you will have to pay money. You'll have to pay taxes on this 50,000. But it might be 20 years from now. But in 20 years from now, that 50K might be 500K. And now here's the thing. You're going to have to pay taxes on the 500K. Yeah, what do you care? Okay, what do you care? Because by the time you pay taxes, you'll still have 400,000, which is a heck of a lot better than your 350. Or maybe you have only 350,000 because your taxes are so high. Yeah, well, 350 is better than 50 any day of the week. So anyways, plus right? Because remember, you're not collecting any of that income. You would reinvest, 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 compound, 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 compound. Okay, compound, compound, compound. You're just compounding like cray-cray. Okay, and that's from 1 year, you see? If 50K compounding at 10% annually for 20 years, or maybe it's only 8. We're trying to get 10. Maybe it's only 8. Maybe in good years it's 12. In bad years it's 6. But it's designed to earn income regardless of the net asset value. But anyways, you compound like cray-cray. So 1 year of deferred pleasure gets you 10x return. And then year 2, you got another you got 490. Year 3, you got 375. Year 4, okay, you're a very wealthy person. Yeah, Darko's like, there's also less places in the world charging less tax, but this would be, this would all be domiciled in the United States for Americans. Okay, anyways. Right on, man. So anyways, this is what I daydream about. This is what I daydream about. So imagine part of that fund has a strategy. Remember, 20% is used for the strategy. Strat. 80% is just owning assets. Okay? So it's an asset-backed security. And part of the strategy to earn income is owning Mexican peso. Not at 100-to-1 leverage, but maybe 10-to-1 leverage. And so you wait and you catch one of these moves. Okay? And you're in here, or you're in here, and now we're lower, so you remove the risk. Okay? So now your stop is at break even. Okay? And guess what? That investment, internal rate of return, dollar for dollar, pays roughly 100% a year. So if it was a small investment from this 20, it's contributing to what it's trying to achieve. Now remember, a second part of the strategy is collecting dividends, which might get us 1/3 of the way. So now we're trying to, with the other money, 2/3 of what we're trying to do will equal 6% a year. Okay? Because 1/3 is earned from the dividends from buying the right assets. And remember, we're not even talking about asset appreciation contributing to the income, because it's not income, it's just asset. Gold doesn't pay you interest rate. Okay? So anyway, so this 100% a year investment into Mexican peso using 10-to-1 leverage, it gets you a high internal rate of return, but a low absolute return. And it's just contributing to an overall strategy. 20% of all assets are just trying to get 6% a year. And you're like, dude, with some Forex, some structured products. Oh yeah. Oh God. Meanwhile, I want those assets hedged. Can you think of anything more conservative than that? So anyways, that's what I like. To me, it's financial engineering. Okay? It's just math. Yeah, well, the interesting thing is, so if you're going like, if you're doing a, Hungarian, I always call them francs. I know it's not right. What is it, fioras or something? The difficulty with doing emerging market, developing market type investments that pay high yield, forenta, is that growth is low and inflation is high. So the example I usually give here is investing into Argentina. And Argentina pays you 20% a year on their bonds. And you're like, oh my God, 20%. Yeah, but they have 30% inflation. So you're guaranteed to lose. That's why nobody buys it. So like, you got to be careful. You're like, well, you can go to Hungary and produce the 13%, but 13% in the local currency relative to the dollar. And then that's all of a sudden it's a bit of a stretch. There's a lot of variables going on. And as a manager that's trying to only earn 6% a year as a minimum, and remember, anything else I earn above that, I'm going to reinvest back into the fund. So you're going to get a maximum of 1% a month, which is huge, by the way. I would say that's too risky for me. That's too much risk. Now you're like, yeah, but peso's risky. Peso is risky, but it's also closer to home. Priced in dollars. The Mexican economy obviously is directly impacted by the U.S. economy. So it's not as much of a stretch. In economics, there's something called nearness, right? Sometimes the nearness is cultural nearness. So investing into the UK, not only is the UK physically closer to the United States, but it's culturally closer. But then there's physically closer, right? Like, if Mexico's largest trading partner by far is the United States, and I'm in the United States and I'm investing in the United States and I own the United States, then half of the equation is already taken care of. I'm already pegged to the dollar per se. And so now I've already neutralized the dollar, and I've already kind of been compensated for the nearness of maybe not the culture, but of the economy. So I'm already kind of in the equation anyways. So the next thing is, if I believe the Mexican peso is going to drop like a ton of bricks, well, that's why I have a stop loss. And I'd get out before I lose money. And I'm like, oh, well, at least I collected some income for a while. And it's not that big of a deal. But I don't want to start suddenly, I'm lending money to like Ghana and the Congo. And, what's up, Djibouti? Lending money? No. Okay. Well, so the short, right? Yeah, short euro huff, but the thing is, I believe euro is going to go up. So anyways, so that's not what I'm trying to do. I don't want to earn income because of risk. No, I'm trying to remove risk. Okay? An asset-backed hedged portfolio. Right? So, no, I wouldn't do that. Right? I'd rather add a little more leverage to the peso trade, maybe 15 to 1 instead of 10 to 1, because I can still manage it easily and earn that income. Right? So anyways, there's just easier ways of making money, I guess, or let's say less risk. So invested into over-the-counter structured products. Like, that's one thing I really like, and I've been working with a hedge fund that does this. It's amazing that you get these private contracts with banks. But you wouldn't give 100% of the money toward that, right? So if I'm trying to pay everybody 1% a month, but the bank is willing to pay me 2% a month, well, I could take half of all the available money and just do that, but then that would be risky. And so I want 80% of that money to be asset backed. So now I only got 20, so I couldn't even go half. So I could take the whole 20 and give that to the structured products. But then that would be risky. If anything went wrong, then, I got retirement accounts I'm worried about. So I can't do that. So maybe 10% of the 20% I can put toward private deals. So not a Forex trade like selling the USD Mexican peso. Anybody could do that. But what if it was a private bank trying to manage their Mexican peso risk? And they're like, we're overexposed to the dollar. Can you take another side? Can you take some of the risk off the peso for us? And I'm like, well, I was going to do the spot trade anyways. So all of a sudden they're like, okay, give us, $200,000. And in 60 days, we'll give you $200,000 back plus 40 grand. So you'll get 240 grand back. Meanwhile, during that period, our risk will be neutral. So now you own Mexican peso basically, and I'm worried about it falling in value. So now I could just sit around waiting to hedge. If Mexican peso goes up, I hedge. If Mexican peso falls, I don't hedge. And at the end of the period, 40 grand goes into the kitty to be distributed to shareholders. You see? And I'm like, dude, oh my God, all you need is access to the private deals. Well, I know how to get those. Okay. Anyways. Sorry, I went to bed early last night, and that's what happens. So, very few people have left, so I guess you enjoyed the conversation, so that's cool. I'm glad. All right. Let's move on. Well, right on, Cash Insomnia. Thing is, I need to do it. I want to do it. Oh, look at this. The chat is weird. Let me fix that. Oh, interesting. Yeah, Nary. Well, I guess, when you spend so much time like I do staring at the charts, like you've seen it all so many times. You're like, you already got that. And to like go through it and like, here's what I talked about last night. Here's what I talked about yesterday afternoon. Here's what I talked about yesterday morning. Here's what I talked about on Sunday night. Meanwhile, over the weekend, I looked at this and I thought about this, and all of a sudden you're like, gee. Okay. Yeah. If you were a bull, you should have bought it 2 days ago. But I already did this for you, right? So like, that's where I could get caught up. I'm like, dude, here we go again, right? Wayne, talk about euro dollar. Oh, okay. You should have bought the pullback. Very basic role reversal. Okay. Okay. Now, this is interesting. Okay. I'm not really looking at the moving averages yet. I consider this market neutral. Okay. Okay. So this is what is probably going to happen. based on conservative disciplined trading. All I'm doing is I'm trapping. Okay, cool. Now the next part of this, if you attended my event yesterday, okay, rumor on the street is it was worth at least $13.50 worth of value. Yet I only charged $11. You would know what I'm thinking about this and about, okay, this. So both currencies. And you would probably have that filtering through this because your brain is either thinking we're going here or we're going here. And I used fact-based evidence to create a reasonable picture for the next 90 days. And it had to do with, would you invest into commodities or would you invest into owning the currency? Meaning you don't invest into a commodity, so you're owning dollar because you don't want to own the stock market. You don't want to own Bitcoin. You don't want to own iron ore. You don't want to own wheat. Okay? But if you do want to own those things, then money goes this way. If you don't want to own those things, money goes this way. That's all it is. It's pretty simple. And so based on your interpretation of the facts I gave you, there's here or there. Now, let me just pick one, and there's more room to the downside, so I'll pick one. Can you sell here? No, I would consider that support. Only, okay, bulls don't sell at support. Bears don't sell at support. Bats. Only bats sell at support. What's a bat? A broke-ass trader. Right? A broke-ass trader. So anyways, what you want to do is sell the retracement. Okay. And by the way, does anybody need the purchase link? There's 6 more days left before that video is taken down. Pigs get slaughtered, but I think pigs are more like buying and selling in the middle. That's not the middle. So I'll have to define that, Ann. Right? Okay. You do? I think I have it open. That's why I think I can get it. Is it this? Yeah, there it is. Hang on. Nope. Delete. I think this still works. Yeah, there we go. So, recording removed on Monday. Got to watch it before Monday. I believe it's a solid hour long. Right? I believe it's like an hour and 4 minutes long. I have it here, actually. Let's take a look. So this is where you get taken after you pay. You go to the live presentation. Oh, kicked me out. Webinar replay. There we go. I don't know why it does this, but you have to click twice. And now you're here. And it's, yeah, hour and 4 minutes. I like this at the end. Look at all the,
and we will probably end sort of like it'll go
I don't
up
have sound.
and it'll
I
come
guess
down,
you can hear it.
and that'll be the Q2. And we'll just kind of
Hang on.
wait for more
At
and
the
more
very
data.
end.
So you end up having maybe I'll stop the recording, I'll stop the sharing,
Look at all the
I can
thumbs up.
restart it without the sound going through my sound card, and then there won't be an echo. So I just want to thank you for being here, and I hope you really enjoyed it, and I hope you found at least $13 worth of value. It probably took me 13 hours to do it, so try to give you a deal for $11. So hang on, I will stop the recording, and then I'll...
Anyways, there you go. It was pretty funny. And all the little thumbs up. Anywho, yeah. Yeah, without the Q&A. Yeah, I stayed after. But look, for those that attended live, they get a little extra love, you know? Yeah. Anywho. So we looked at some commodities, we looked at some crypto, we looked at some exotics. We looked at gold, whether you should know if you're buying gold or not. Again, I covered it yesterday in the day trading group. It's up since then. Yeah, you should know what you're doing here. I don't feel like anything has changed in the last little bit. And I've been saying this since about Friday. And it's interesting because here's like the S&P 500. And this is what we've done over the last 2 weeks. Okay. And so you need to be planning this or this. And so going back to Anne's question, and this is kind of where the pigs are now. You're not high, you're not low, you're in the middle. And very often pigs get slaughtered. Classic example is looking at, let me change this just purely monthly here. Okay. Typically, right, you have a scenario where this is your selling price for April. This is your buying price for April. So bulls buy, bears sell, and pigs get slaughtered. Do you know why? Because they're fighting both the buyers and the sellers. Okay. Okay. That's that. So Richard's thinking bearish. So one way, this is what happened last month. Just like I just drew, okay? This is the selling price last month. This was the buying price last month. Okay, people in the middle got slaughtered. Okay. And it turns out the bears won and the bulls would have got knocked out at break even. They would have had plenty of time to move their stops. Cool. So Richard's going to do the same idea here to here. Makes sense? Because this is the price action pivot points. Right? Look at the price action pivot points. What are they telling us? Let's try to project. Oh, did it again. Can't go off screen. Okay, we'll do it there. Okay. They're trying to project that. Okay. So somebody's already taken the shot. Okay. Now the idea is down and up and then down and then up and then down. And if it's early in the month, then all the way back and then probably back down again, right? So that would be Richard's trade plan. Now, he doesn't know the future, but he knows in the market conditions where the S&P 500 falls, he will do well. Okay, if you're trying to be both a bull and a bear, you'll never compound. Okay? You're all income and no asset appreciation. You have no assets, you're only income. An asset's something that will continue appreciating, right? So if, let's say, in here you sold the S&P 500 and you stayed short and it's going to keep falling, it's appreciating day after day after day after day after day. Anywho, so that's what a bear would set up. And do we know if that's right? No, but I know what a bear would do. Easy. Okay, what would a bull do? Okay, well, they see this as the end of that old trend. Let me do this in a darker kind of purplish color or something. Crimson. Okay, they see this as the end of, right, or let's say the beginning of a new narrative. And they're going to buy, let's say, somewhere in here, have it come up here, and then top out up there. Okay? And you get one of these things. And you get this, right? And you're like, oh my God, that's such a coincidence how these pivots overlap. It doesn't, it's not a coincidence. It's math. It's math. It's math, bro. It's just math. Okay? That's right. If there's more run on banks, that could trigger, yeah, easy. The thing is, you got to pick one. I was thinking about, after the presentation I did last night, I was thinking about it. And I'm like, I should have ended with a slide that says, like, or flip a coin. If you can't figure out whether you should be bullish or bearish, simply flip a coin. And that will tell you your bias for the next 3 months. And if your bias was bullish and the S&P 500 keeps falling and falling and falling and falling, and we're stuck in a channel like this for the next 3 months, you're not going to have any trading opportunities. But it's a hell of a lot better than losing money. Okay? Because you can't be a buyer unless it's making higher highs and higher lows. You just can't, by definition. If you are a buyer and you're buying in a market of lower highs and lower lows, you don't know what the heck you're doing. You might be a degenerate gambler, or you just might be naive, Or you might be not smart. One of those. But if you're patient and disciplined and you're like, I'm a bull, or you flip a coin and it says to be a bull, great. Now you're a bull for 3 months. And if it falls, you end up spending 3 months not losing money because you never get an opportunity to buy because you were wrong. Well, that's perfect. You only want to trade when you're right. And then have the confidence and strength to let those winners run. Okay. So yeah, so Richard's like, if there's more runs on the bank. I don't think it'll be a bank though. We're gonna, like this happened to us in the UK. Do you guys remember when pension funds had a problem? Why did pension funds have a problem? They bought a bunch of bonds that paid 0% interest rates. Okay, so banks are now shored up. So who are we not watching? How about brokerages that act like banks? How about shadow banks like Charles Schwab? What if there's a liquidity challenge at Charles Schwab? I was going to try to find it. Stupid thing takes me somewhere I don't want to go. Anyways, this will be good enough. Okay, what if it's a company like Charles Schwab? Whoa! Whoa! What? $80, $80, $80, $80, $80. 3 weeks ago. Look at this. It went from $76 to $52 in a week. Oh, God. Okay. And we're talking 25 bucks, right? Like, holy smokes, it lost 30% this month. Oh, God. 24 bucks. Okay. I worked for a company that got bought out. And one of their major customers was Schwab. So I used to work right next to Charles Schwab in San Francisco. 555 Montgomery. What is that? Transamerica Pyramid, I used to eat lunch there all the time. And Schwab used to be right in there somewhere. I think it was... Wait, where's the bay? Yeah, the bay's that way. Oh, no wonder. All right. Yeah, well, maybe it moved. Anyways, cool, man. Yeah. Whoa. Sorry. Yeah, sorry. Yeah, so so I used to work across the street from the Transamerica Pyramid. Yeah, man, I used to walk through those doors every day. There used to be a cool coffee shop. I think it was here. Oop. Oh, it's gone. Cool. I have to look. Look, then later on, so that's when I worked for somebody else. I used to have my own office. I was on Market Street, but then I moved over here. I want to check this out. Hang on, I want to see my old office. This is Kearney, isn't it? Oh, it looks like crap. Is that Kearney? There it is. That's my old office. Look, it looks like crap now. Dude, California's gone to hell in a handbasket. I think it was that. I don't even recognize it. This used to be my office right here, right there. I used to go up on the rooftop and watch the parade. Is that it? I don't even recognize it. Weird, dude. Weird. This building has a beautiful elevator inside. I don't recognize this place. Maybe I'm wrong. Is it or not? No, it's Kearney. I don't recognize it. Or was it this building? Ah, it's horrible. Sorry. I used to eat here. It's all right. Let me show you this bar. It's where friends and women meet, or something like that. The Buddha bar. Oh, it doesn't let me go. Oh, it's gone. I can't believe it. San Francisco's gone to crap. This place is a dump. What is that? That's new. Sorry, I haven't gone here in so long. What a dump. I don't want to go back. Oh my God. I have so many good memories there. It's all gone. It sucks. Yeah, Chinatown is right there. It used to be cool, and we used to watch Chinese New Year and stuff. Look, I was a young guy. It was a big deal to have an office. But that building, even though it looked terrible, it had a birdcage elevator. It was wild. It was all open, and you'd open the door, and it was like a folding scissor door, and you'd get in and close it, and then you'd do and you'd look up and you could see up above you like a bird cage, and you'd go up to the next floor, and then you'd get out. It was awesome. It was so strange. Before then, I was on what was it? What's that main street? Montgomery, California. I used to be at California, which is interesting. And then later on, I ended up moving. My business grew, and I ended up having, I don't know, 8,000 square foot office with a break room, bathrooms with showers, like a break room, a proper break room. We had a server room. I was so proud of having an office supply closet. We had a theater room. We had a meeting room. And the cool thing about that office is all the walls were covered in whiteboards from the floor up to about 10 feet, I think the maximum you could get. but our ceilings were 16 feet tall, right? So anyways, we had 10-foot tall walls, 100% white marker board, the entire walls. And I had thousands of markers just laying on the floor all over the place. And if you ever got an idea, you just pick up a marker and write it on the wall. Like, oh, we had so much fun. Anyways, I digress. Markets are moving sideways and I'm still not interested. But some things might be developing, but I don't like trading might. So that's how we get here. So maybe don't trade today and maybe watch the video recording from yesterday. It will be taken down in less than a week. I'm not going to email any more times. I might send one more email to Quant-in-a-Box people that are not on the FX Bootcamp list, but I don't have time for that. So nah, forget it. So yeah, no more emails. Be taken down in 6 days and all that kind of stuff. So today is a very busy day at FX Bootcamp. All members of FX Bootcamp, right, live groups will be meeting for the Stop, Look, and Correct session. And then at 4 p.m., you'll be meeting for the day trading session if you're in the day trading group. Yep. So anyways, nothing going on. Nothing going on. Nothing's right. I'm torn. Well, just remind yourself you're a profiteer. And if there's no obvious trend in play, stay out. Look at this DAX. No higher high, no lower low. What should you be doing? I don't know, planning the next quarter. Yeah, peace on earth, may the pips be with you, may our profits be above average.